equation, which is just definitional, right? Assets equals the liability plus the debt. It's definition of a company. And then we apply that to bookkeeping. Now, the fact that assets are over here on the left and liabilities and equity on the right, it's just pretty much random. We could actually have those over here and assets over here, but that's the way they set it up. So the asset side is the debit side. And what kind of things are assets? Like, what can you list some assets?
Cash.
Buildings.
Yep. Accounts receivable.
Inventory.
Yep. So those are resources. Those are usually pretty straightforward. So assets, all of these are good. So we've got some short term, and you gave me one long term, land, equipment, all that would be also in there. There's things like intangible assets too, like goodwill, would also be in there. So there is a category of things that don't have physical substance. And when we delve into those a little bit more, we'll talk about valuation of those. You know, how do we value those? Do we value those at historical cost or fair value? Do we have to have an allowance against them because we're worried that they won't come to fruition? So, like receivables, right? We sell to some people that we know we won't collect on. And so we have to have an allowance for that. So we'll get into more of that when we look at these specific ones. Okay, so liabilities carry a credit balance. You know, if you just, that one's pretty simple. One category, credit. What kind of liabilities can you think of?
Notes payable. Accounts payable.
Interest payable.
Long-term debt.
Bonds payable.
Yeah, that's a good one too. Okay. Awesome.
Is unearned revenue?
Yes, that is. Yep. Do you know why it's in that category?
No, that one's kind of.
Does anyone know why that would be in that category?
You've received the money, but you haven't done the work yet, so you're owing them the work yet, basically.
Absolutely, yeah, that's absolutely right. So you increase your cash and you can't record revenue because you haven't done it yet. So it's sort of like a holding account for it. So it's a debt. So you owe that service. That's a great explanation. And that one's tricky because people see the word revenue and they want to put it into equity, but the unearned revenue does go into liabilities. Equity, overall, equity is a credit overall. There's a lot of components of equity, but if we look at some of the major ones at this point, I'll list some. So equity, we've got revenues, expenses, common stock, and dividends. Okay, so all of these together should have a credit balance. But individually, there's some that offset each other. Okay? So there's some that you can think of that will make up or increase equity, and then some draw away from equity. So things that you feel are draws out of the company, those should be debits. So looking at this list, which ones are draws away from equity? Dividends,
Expenses.
expenses. So if you can remember, those two are your debits. They're offset by the credits. And you should have more revenue in stock than you do outflows of expenses and dividends.